Hello and welcome to another deep dive video. Today, taking an in-depth look at Oracle Corporation, ticker symbol ORCL. We'll dive into financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Oracle Corporation is an American multinational computer technology company headquartered in Austin, Texas. The company sells database software, particularly the Oracle database, and cloud computing. Oracle's core application software is a suite of enterprise software products such as enterprise resource planning, ERP software, human capital management, software, customer relationship management, enterprise performance management software, customer experience commerce, and supply chain management software. As of the 9th of December 2024, the stock is priced at $191 with a market cap of 531 billion. Now let's have some key valuation metrics. The price to earnings ratio stands at 49.4, very high, especially noting that the median PE over the past 10 years was 25.4, and the price to cash flow ratio is 27.8. Over the past 5 years, the company's revenue has grown by 35.6%, and its bottom line has increased by 3.3%. In terms of earnings per share, there's been a growth of 20.5%, and notably the number of common shares outstanding is 2.8 billion, a minus 14.1% change over a period. Now, this is the company's liquidity and solvency. The interest coverage ratio is 4.7, which, to be honest, for such a big company, you'd expect it to be higher. I think this is a bit underwhelming. The quick ratio measure of the company's short-term liquidity is 0.72. This is not really horrible, but they do have a bit of a problem with short-term liquidity. So if they ever have a short-term liquidity crunch, then yeah, there will be a pretty big problem. Additionally, the long-term debt equity ratio is 6.7, and the total debt equity ratio is 7.5. Uh, now this is a bit too high. Normally, in banks or in companies like PayPal or Amex, XP, this wouldn't be a problem, but to be honest, for a software company to have such a big debt equity ratio, it's pretty bad. I mean, yeah, sure, they have 20 billion in treasury, so that means they did 20 billion in buybacks. But even if you add that up in the equity, they still have a debt equity ratio of about 2 and a bit, which is, to be honest, too high. This, of course, can be seen in the interest coverage ratio, which is pretty low. Shifting to the cash flow statement, cash flow operations stands at 18.7 billion, reflecting a growth of 42.1%. Cash from investing activities is minus 7.5 billion, with a minus 174% change, while financing activities are at minus 10.5 billion, showing a plus 72.1% change over the same period. CapEx has increased by 339%, and free cash flow has grown by 2% to 11.8 billion. Moving forward, let's look at the return metrics, see how the company is utilizing its resources. The return on equity is 141%. Of course, this is very high because two-thirds of their total equity, including buybacks, is 30 billion. But because they did buybacks, they have the 20 billion in treasury stock, so their equity is only about 11 billion. Their return on equity, including buybacks, is closer to, I guess, 40 something percent, which is great, but definitely nowhere near 141%. The return on investment is 18.5%, the return on assets is 8.8%, and the return on invested capital stands at 10.1%. Finally, let's find the total buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 9%, a revenue growth rate of 5.5% for 10 years, and a perpetuity growth rate of 2%, we get a fair value of $91.45. Secondly, using a multiples valuation of 20 times earnings, operating cash flow, 25 times free cash flow, we get a fair value of $105.7. And finally, the next price target is $182.96. Putting it all together, we get an intrinsic value of $126.7, and using a 15% margin of safety, we get an acceptable buy price of $107.7, suggesting that the stock at the current levels is overvalued. To wrap up analysis, I rate Oracle Corporation as a sell. Now, there are two main things going into this sell rating. First of all, they have low revenue growth and very high capex growth. Why? Well, why is this a problem, you may ask? Well, as you can see, their free cash flow has only grown by 2%, while their operating cash flow has grown by 42% and their revenue has grown by 35%. The problem is that if you manage to only grow your revenue by 35% and your cash flow operations by 42% whilst increasing capex by threefold, more than threefold, you have a problem with growth since they have to invest so much into growth, into increasing their revenue. Now, maybe in the future, all of this capex will boost them a lot and they'll start growing without having the need for more capital investments. But such a low return on capex is, in my opinion, not really that great. Um, if you believe that the capex will start decreasing and their free cash flow margin will start increasing because of that, maybe that will definitely increase the DCF valuation a lot. But for now, I think that capex is a bit of a sign, actually a very big sign, and sort of an elephant in a room, that is showing the company is reaching basically dinosaur stages levels of growth. I mean, imagine if Google increased capex by 400%. Of course, they did increase it, I think, like 100 and something percent for AI, but still 400% or 340% in the case of Oracle. That is insane to only get a 35% growth in revenue. The other big problem, their balance sheet. Now, of course, that was one problem, and this is the next problem, the balance sheet. Their balance sheet is, in my opinion, atrocious. At least for a company their size, a company their uh, their size, their time in the market, their experience. Yeah, it's pretty bad. To have such a high debt to equity ratio, to have such a bad interest coverage ratio, I think those are pretty bad signs. Now, they are lucky that interest rates are dropping worldwide, but still, if you think about it, it should not be up to the government to lower interest rates for a company to have a secure debt. There are a lot of companies that have interest coverage ratios in the 15 to 20 range. Uh, in the current moment, so with these high interest rates, a company should be secure no matter the interest rates. If a company is only based on the current environment, then that means that the current company itself is too open to risk. Imagine, for example, a scenario where inflation starts going up back again from Trump's tariffs, and the interest rates, I don't know, goes up to like 7 or 8%. I know it's absurd, but imagine that scenario. Uh, in such a scenario, the interest coverage ratio will probably drop to three or I don't know 3 point something. And when your interest coverage ratio drops to three and a bit, the that creates a lot of pressure on the company because if you think about it, you have a EBIT, which is I don't know 18 billion for them, and you take one third of that, so 6 billion, and you put it into paying interest payments. Think about it. That's 6 billion. That's not going to shareholders because they have managed to pull up so much debt from a diverse set of investments, and for that much debt, they only get a 8% or 7% revenue CAGR. So think about it. You get all of this risk, and you get basically mediocre revenue growth, or not mediocre, but definitely not really that exciting. Now, of course, you should do your own analysis and your own due diligence. Thank you for watching. If you found this video helpful, please like and subscribe for more detailed analysis, and also check out my investing blog featuring in-depth analysis from the link in the description below. See you in the next video. Bye.